Welcome back, traders. Whether you're a seasoned market veteran or just starting your Forex journey, one challenge remains constant: the moment you decide to enter a trade, and even more crucially, the moment you decide to exit. Today, we're diving deep into the often overlooked factor that can make or break your trading success: the psychology behind those entry and exit points. Forget complex indicators for a moment. Let's talk about the battle that happens inside your head. You've spent hours analyzing charts. The price is hovering near a key support level, the RSI is dipping into oversold territory, and you've seen the price respect this level multiple times before. Every signal is screaming, buy. Your finger hovers over the trade button, but you hesitate. What? Maybe it's the fear of being wrong, the nagging doubt that this setup is too obvious, and the market might reverse just as you jump in. This is the psychology of the entry point in action. Point 1. The paralysis of fear at entry. Fear is the biggest enemy at the entry point. Fear of losing money, fear of missing out, FOMO. If you wait too long, fear of making a mistake. This fear can manifest in several ways. Analysis paralysis. You keep looking for one more sign, one more confirmation, delaying your entry until the setup potentially fades away. Second guessing. Even after deciding to enter, you constantly question your analysis. What if I'm missing something? What if this is a trap? Hesitation. That split second of doubt can be the difference between getting in at a good price and chasing the market at a much worse level. Host. The key here is preparation. Before the market opens, have a clear plan. Where is your entry trigger? What is your stop loss? What is your initial profit target? Knowing exactly what you're looking for and what you'll do reduces the decision fatigue and the room for fear to creep in. Trust your process, not just your gut feeling in the heat of the moment. Okay, you've overcome the fear, press the button, and you're in the trade. The price moves in your favor, fantastic. You're up 10 pips, then 20, maybe even 50. Now, a new psychological battle begins at the exit point. Do you take the profit now, secure in your win, or do you hold for more, hoping for that big score? Point 2. The temptation and greed at exit. Host. Greed and the desire for perfection often dominate the exit decision. This can lead to holding too long. You've hit your initial target, but the profit is looking so good. You start dreaming of doubling it. Suddenly, that trailing stop loss seems too close, too conservative. You ignore your plan because this time is different. This is how profits turn into losses. Chasing unrealistic gains. You convince yourself that the market must go further because your analysis is so strong. You override your risk management rules, increasing your position size or moving your stop loss further away, exposing yourself to unnecessary risk. FOMO on missing more profit. Seeing the trade continue to run without you can be agonizing, reinforcing the idea that you should have held longer. This can lead to taking larger, riskier trades in the future to make up for lost profits. Host. The antidote? Discipline and adherence to your trading plan. When you enter a trade, you should already know where you might exit for a profit and where you must exit to cut a loss. Set your stop loss and take profit levels, or mental levels if not using automatic orders, before the trade is live. Stick to them. Remember, a small, consistent profit is far better than a large profit followed by a devastating loss. Protecting your capital is paramount. But what happens when things go wrong? You entered and the price immediately moves against you. This is where another critical psychological challenge emerges. The pain of losses hurt. They activate the pain centers in our brain more intensely than equivalent gains activate pleasure centers. This pain can lead to holding on to losing trades. You don't want to accept the loss. It will come back, you tell yourself. You ignore your stop loss because admitting you were wrong feels too painful. This is often the biggest source of trading losses. Getting even mentality. After a loss, you feel the need to immediately make it back. This leads to taking impulsive, high-risk trades without proper analysis, just to recoup the loss quickly. This is a recipe for disaster. Moving the stop loss. You move your stop loss further away to give the trade more room to breathe. Host. The solution is acceptance and objectivity. A trade is just a trade. It's data. It's not a reflection of your worth as a person. When a trade goes against you, review your plan. Did you follow it? If yes, then exit at your predetermined stop loss level. Accept the loss as part of the game. Don't let emotions dictate your actions. Focus on the long-term profitability of your strategy, not the outcome of any single trade. So, how do we actually train our minds to handle these psychological pitfalls? Point 4. Building psychological resilience. It takes conscious effort. Develop a clear written trading plan. This is your roadmap. It removes ambiguity and gives you something objective to refer back to in moments of doubt or excitement. Practice with a demo account. Trade your plan with virtual money. This allows you to get comfortable with the process, test your risk management, and experience wins and losses without real financial pressure. Pay attention to how you feel during these simulated trades. Keep a trading journal. Record not just your entries, exits, and results, but also your thoughts and feelings before, during, and after each trade. This is invaluable for identifying recurring emotional patterns. Did you hesitate at entry because of fear? Did you hold too long out of greed? Recognizing these patterns is the first step to changing them. Focus on process, not just profit. Your goal should be to execute your trading plan with discipline, not just to make money. If you follow your plan, the profits will come over time. This shifts the focus from outcome anxiety to process execution. Manage your risk. Never risk more than you can afford to lose on a single trade. This reduces the emotional stakes and makes it easier to stick to your plan, even when things are tough. Take breaks. If you find yourself getting overly emotional, angry, anxious, greedy, step away. Trading when emotionally charged is a recipe for bad decisions. Trading Forex is as much a mental game as it is a technical one. Mastering the psychology of entry and exit points is a journey, not a destination. There will be days when fear wins and days when greed takes over. But by understanding these common pitfalls and actively working on your discipline, preparation, and emotional management, you significantly increase your odds of long-term success. Host. Remember, the most successful traders aren't necessarily the ones with the best charts. They're the ones who can control their minds when the market is testing them. Keep learning, keep practicing, and keep working on that inner game. Thanks for tuning in. Until next time, trade smart, trade disciplined, and take care. Like and subscribe for more.